Principles of Macroeconomics, Chapter 15, Monetary Policy and Bank Regulation, Professor Wagner. The discussion will revolve around the Federal Reserve banking system and central banks in general, bank regulation, how a central bank executes monetary policy and economic incomes, and the pitfalls for monetary policy. This is the Federal Reserve headquarters, and this is where the top Fed officials make monetary policy, such as quantitative easing, the setting of interest rates, and that sort of thing. Although there are regional Federal Reserve banks, and they get to weigh on the decision as well. A central bank is basically ensuring that the nation's financial system is running smoothly. In the U.S., the Federal Reserve is, or the Fed, that's, the central bank for us. It's really semi-decentralized, and it's run by a board of governors consisting of 7 members. And the president gets to appoint these, and they're confirmed by the Senate. Other central banks is like the ECB, that's a European central bank. And so they control the monetary policies revolving around the euro currency. And most developed countries have a central bank, and they're responsible for the monetary policy surrounding their economy and the availability of money supply. The chair of the Federal Reserve Board is like one of the other 7 members. They get 1 vote, they control the agenda, and is the face person for the Fed. This is Janet Yellen, the predecessor of the current Fed chair, which would be Jerome Powell. The Federal Reserve comes with 12 districts, and so there are 12 Federal Regional Reserve banks, which are responsible for supporting the commercial banks within their district or region. Also, they are a very good resource for economic papers and economic data. If should you ever decide to go further into economics and you are required to do some research, they provide a tremendous amount of data for academia. There are 3 important functions for central banks. They conduct monetary policy, they promote the financial stability of the system, and to provide banking services to commercial banks and depository institutions, and provide banking service to the federal government. Banking regulation exists, and it's intended to maintain the solvency of banks and have them avoid excessive risks, and there have been a number of historical incidents over the last 100 years regarding banking practices. The latest is investment banks being combined with regular retail banks and taking depositors' money and playing the stock market with the capital. There have been some very bad results, such as the financial recession during 2008 is one of the most recent. And so, they've tightened down the regulations. There's the Frank Dodd, which tests bank strengths, and there's a stress test for banks where we, make sure that the bank is able to handle economic shocks. Bank supervision, there are a number of government agencies that monitor this. And so we have the Comptroller of the Currency, the National Credit Union Administration, and the Federal Reserve itself. Bank runs. Bank run is when everybody tries to get their money out of the bank. And the bank run during the Great Depression only served to worsen the economic depression. So that's one of the reasons that we regulate banks to the extent that we do. And we try to maintain the general confidence of people in the money supply and the system. Otherwise, you run into a situation like this. That's one of the reasons the Great Recession did not turn into another Great Depression, was because of Federal Reserve intervention. Deposit insurance and lender of last resort. The risk of bank runs creates instability. And to protect against it, there's deposit insurance like the FDIC, and they make sure that their deposits are insured. I think the current number is either $250,000 or $500,000, but some years ago was take that back, $250,000 or $500,000, and previously it was $100,000. Lender of last resort, an institution provides short-term emergency loans in conditions of financial crises. So there's a backstop, and these are safety nets for depositors. Now, how central bank executes monetary policy. It involves managing interest rates, market conditions, which will influence the economic activity. The most common is open market operations, and the central bank is either selling or buying bonds to influence the quantity of money and the level of interest rates. And then you have the Federal Open Market Committee, which decisions regarding open market, and it's comprised of the board, the 7 governors, and then also 5 voting members from the regional reserve banks. Okay, illustration using T accounts, assets equal liabilities plus net worth. If you take an accounting, it would be assets plus owner's equity. But we're talking about a bank, so they call it net worth of the bank. And so what they have, in this instance, they have 300,000 loans outstanding, 120 bonds, and reserves of 400,000. They have deposits of 400,000 and a net worth of 60. And that's the difference between these numbers. They have to be equal on both sides. And so this is how they arrive at that. So if the federal bank purchases 20 million of bonds from Happy Bank, you got to subtract 20 here, and then that would be 100, and then you'd have to add 20 into the reserve. So everything happens on this side of the sheet. But the bond holdings of Happy Bank fall by 20 million, and the reserves rises by 20 million. Okay, this is an instance where the bank shows an extra 20 million reserves and its loans rise by 20 million. And so you take, if you loan out 20 million here, you have 40 left over. You have outstanding loans of 300, but now you've just added another 20 million of loans. So this is the new number for loans. This side still has to equal that side. That's the constant. So nothing is created or destroyed in particular. The money's been shuffled around. Continue decreasing the money supply using the T accounts. This illustration shows the balance sheets before, and then this is after. It purchases 30 million in bonds, so it's plus 30 here. That came from the reserves, and so the new numbers are 10 in the reserves, 150 here, 300 still adds up to 460 over here. And then what now holds it sends 30 million reserves to the central bank, but now holds an additional 30 million in bonds. And so the numbers reflect that. A continuation on the idea of money supply shows the Happy Bank wants to hold 40 million in its reserves, so it can adjust down the quantity of its loans by 30 million or bring its reserves back to the desired level. A bank can easily reduce its quantity of loans by slowing down or briefly stopping to make new loans. This operation causes money supply to decrease. Changing the discount rate. This is a third method. And what is involved is the interest rate charged by the central bank on loans. It gives to other commercial. So if if the central bank raises the discount, and then commercial banks will reduce their borrowing of reserves from the Fed, namely because the money is more expensive, and instead call in loans to replace those reserves. Since fewer loans are available, money supply falls in the market, and interest rate rises. If the central bank lowers the discount rate like they've done recently, it charges the bank. The process works in reserve, so we're actually increasing money supply here at the bottom. And these are a couple of terms, and you'll hear them. Probably want to look at these for the test. You have expansionary monetary policy, or what they call loose money. Also contractional monetary policy or tight money policy. So these are stock terms to describe monetary policy, whether they want to expand the supply of money or contract it. Okay, the effect of monetary policy on interest rates. There's the Fed funds interest rate, which is the rate at what bank lends to another bank overnight. And so how does a central bank rise interest rates? It's through open market operations, and the bank changes the reserves in a way that affects the supply of loanable funds. The Federal Reserve has since '95 established its target rate in advance of any open market operation. So they pretty much telegraph what they're going to do. And if the open market operations do not meet the Fed targets, the Fed can supply more or less reserves until interest rates make the change. Here's a graphical depiction of monetary policy and interest rates. You have billions of dollars down here, and you have your interest rates. So if you start off with E of 0, which is our beginning point, you have $10 billion. You have $10 billion available at an interest rate of 8%. So if you want to expand monetary policy, which means put more money in the system and bring interest rates down, that would go down by 2 points, or 200 basis points in their world, and increase the supply by 14 million. And just the opposite. So if you contract it, what you do is you want to change the monetary supply curves here. It will now be at 10%, and what their goal would be to get $8 billion. So they want to raise interest rates, so they shrink the amount of currency available. Monetary supply and the aggregate demand, the effect upon each other. It affects interest rates at a quantity of loanable funds, which turns affects components of the aggregate demand. So a tight monetary policy will reduce 2 components, and here they are. It's business investment, because money is expensive. Also consumer borrowing for big ticket items. So a lot of people will maybe not buy a new car because interest rates are too expensive on a large ticket item like that. So you're paying way more in interest, so it's just not really attractive. Conversely, the expansionary policy would make business investment and large ticket item consumption by general consumers much more appetizing. Okay, you have 2 graphs, A and B, and it's basically a depiction of expansionary or contractionary monetary policy. Here, where the economy is originally in a recession, so we're talking about E of 0 here, and with the equilibrium output shown at E0. An expansionary policy will reduce interest rates and shift the aggregate demand curve from 80 to 81. So this curve goes over here, and so we have a price level at 100, and we have 700 constant dollars out there. Okay, this leads to a new equilibrium E1, and and the potential GDP level output with a relatively small rise in the price level. In graph B, the economy is producing above the potential GDP equilibrium. So it's, once again, this is the line that determines whether you're reaching over your GDP, potential GDP, or under that. And so they'll go ahead and do a contractionary monetary move where they'll raise interest rates and they'll shift this demand curve to the left. And so you'll come up with a new output at a higher interest rate. This is a term. Monetary policy should be counter-cyclical. That's moving in the opposite direction of the business cycle of economic downturns and upswings. This is to kind of keep everything in balance and create a more stable marketplace. Pathways of monetary policy. You got expansionary policy, so you have loanable funds in, they increase, and probably want to go ahead and remember this for the test. And then so interest rates are going to fall, which stimulates investment and consumption, and the result will be a higher price level P and a higher real GDP. On the contractionary side, if you reduce the amount of loanable funds, interest rates tend to rise, and so investment and consumption falls. And then likewise, the price level also goes down, at least in the short run, and then you lower your real GDP. This is a continuation. Once again, the expansionary policy behaving as such and the contractionary policy behaving as such, as discussed on the previous slide. Federal Reserve actions over the last 4 decades, and this is a picture of several things. You have Fed funds rates, you have unemployment rates, and so all federal funds rate, unemployment rate, inflation rate, all depicted on here, and they're talking about episodes of financial situations. So this is an economic shock of some sort or another, and they'll talk about the episodes, I believe, in future slides here. Quantitative easing is a long-term government pushed private, Quantitative easing is the purchase of long-term government and private mortgage-backed securities by central banks to make credit more available in hopes of stimulating aggregate demand. This was used at least 4 times during the 2008 recession. Quantitative easing differs from traditional monetary policy in several ways. Fed is purchasing long-term treasury bonds rather than short-term treasury bills. Instead of purchasing treasury securities, the Fed began to also purchase private mortgage-backed securities, MBSs. Pitfalls from monetary policy. Banks are legally required to hold a minimum reserve. There's no rule saying they can keeps them from holding additional excess reserves. And reserves banks hold exceed the legally mandated limit. Velocity of money, the speed of money in which it circulates through the economy. You take the nominal GDP and you divide it by the money supply, and you'll get a ratio. And so you have several more formulas you might see on the test. And so you have the nominal GDP formula, where you take velocity times money supply, and that's equal to price level, or GDP deflator, times the real GDP. And therefore, money supply times velocity will equal price level times real GDP. So you have a substitution here. You have nominal GDP, which goes from here to here. And so since this is equal to that, hence this is equal to that. Velocity calculated using M1, so velocity is nominal GDP divided by the money supply given for any given year. We can calculate the different measures by using different measures of the money supply. Velocity as calculated by the M1 money supply has lacked a steady trend since the 1980s instead of bouncing up and down. Most central banks focus on fighting inflation. So the vision of focusing monetary policy on a low rate of inflation is very attractive and has been rewritten into their central banking law since the 90s. So basically it's called inflation targeting. It's a rule that is required to focus on only on keeping inflation low, but there is a certain low, and I would say that, you know, it's about 2% is our target rate. Their economists, as a general rule, don't have a final consensus of whether a central bank should focus only on inflation or whether or not it has greater discretion. But that is the current modus operandi of the Fed, at least in this country. Monetary policy in a neoclassical model. Monetary policy only affects the price level, not the level of output in the economy. And so for an expansionary monetary policy causes the aggregate demand to go from 80 or to 81 or shift it to the right. However, the equilibrium is the only thing that really adjusts. So it adjusts from here to E1 from E0 to E1, so the price level moves upward. End of chapter 15.